Hello traders, welcome to the Advanced Technical Analysis course. This is the module number 1, Technical Analysis 101. Here you will learn all the basics that you need to get before moving forward into what it is really advanced technical analysis. And in this lesson we will teach you about trending markets and ranging markets. And some of you might already know the difference between a trending market and a ranging market. But in this lesson, we will teach you why it is important to actually know the difference. So, a trending market, it's easy. There is directionality. Price is moving either up or down, okay? In an uptrend, we are making higher highs and higher lows. And in a downtrend, we are making lower highs and lower lows. This is easy, and I think that everyone that is watching this course already knows this. And a ranging market, there is no directionality. Price is trapped in a range. We have a support area that is unbroken and a resistance area that is unbroken, and price is simply bouncing off of these two levels, creating what we call a range. So here's an example of a chart that is trending to the upside. You can clearly see that we are making a higher high, a higher low, 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 etc. So we are in a trending market, and this is a ranging market. We have an area of resistance, of resistance right here that has been tested once, twice, and 3 times. Remember that this is just a fake out because this candle, even though that the blue candle closed above the area of resistance, the red candle opened and closed below it. And we have this area of support which was tested here, 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 and now we are moving up. Okay, so ranges are clear defined areas of support and resistance that remain unbroken, and the trending markets or trends are defined price action that is moving higher or lower. So this is the basic definition of a trending and a ranging market. But why is it important to know the difference? It's important to understand this because we can trade both of these markets. And in this advanced course, we will teach you how to analyze price action both in ranging markets and in trending markets, and how to capitalize from both of them. The techniques and setups we are going to use are different, but we will use some of the same indicators. I mean, in ranging market, we are mostly going to use oscillating indicators because we need to know when price is overbought or oversold to either sell or buy. Okay, and we are going to use that in confluence with our levels. And in ranging markets, we are going to use some other kinds of indicators to try and get on the main move on the corrections that you saw on the previous slide. But this is for another lesson, and for the moment, this is why it is important to know the difference. As advanced traders, we will learn to assess high probability entries in either market condition, and it's important to understand the difference between ranges and chop. And this is key. A range is a clear defined area that has a support level that is unbroken and a resistance level that is unbroken, and price is bouncing off of these two levels, creating an oscillating price action. Okay, a chop is just a mess of a price action that is untradeable but still can be considered a range because it doesn't break a support or resistance. But a range can be traded and can be traded profitably. A chop will only chop you. Once we move forward, you will understand that sometimes small ranges are continuation patterns in trending markets, and this is the key, guys. This is why we need to understand the difference between these two market conditions, because sometimes when we are trading in higher time frames, or not even higher time frames, but when we are trading with advanced continuation patterns, we will find that sometimes ranges in the middle of a move can be a consolidation period before the next push. So you will not trade the range, but you will try to trade the range breakout to get onto the main move. So you will learn how to make the difference between a true range and a continuation pattern on a strong move either to the upside or to the downside. And now let's go to the charts so we can look at some trending markets and ranging markets. Okay guys, so here's my MT4 platform, and what we're going to do here, we're going to go through some of these currency pair charts just to look at some trending markets, some ranges, some chop, and to make the difference between a true range, a choppy price action, and what can be considered as a range but would be better considered as a continuation pattern. So as technicians, we need to understand and we need to know the difference between a true range or a market that is just oscillating between a support and a resistance level that we can profit from, which sounds very easy to do, but it's actually not that easy, because sometimes price doesn't achieve the levels, the extreme levels. But in further lessons we will teach you how to know this for sure way, and we teach you how to use indicators to know that. And of course you need to know the difference between that and a range or a tiny range that might be just a continuation of the main move. And how do you know this? Because when you find a range in the middle of a move, you might feel the urge to trade it, but you need to understand that if it's in the middle of the move, it might be just a consolidation period before the next push, either to the upside or to the downside. And a true range or a true ranging market, it's just a big range, like I already told you, that has no directionality. So the big thing to understand here is that when we have directionality, we need to be trading to the side of the trend, and when we don't, we need to find our entries at the top and the bottoms of the range, and we need to be careful with chops. Alright, so let's open up the GBP/USD, and well, let's start with this. And guys, this is what's called a chop. Okay, let me put some horizontal trend lines here. Okay, and here's another one. Even though we are trapped inside an area of resistance, you can see that it's tested here by this wick here, by these two candles here, a wick, 2 wicks, a fake out, etc., and an area of support which is tested once, twice, 3 times, 4, 5, etc. This is untradeable. Let's imagine you enter here. After the rejection of this area, boom, you have a loser. Let's say you enter here. You might be smart enough to move your stops to break even, and well, you don't make any money out of it. And on the other side, if you enter here, you get chopped. So what I'm telling you is that this has no clear rejections of the areas, and continuous move to the downside, rejection of the downside, and continuous move to the upside. Okay, so to be a good technician, you first need to understand and to make the difference between what is a good market to trade and a bad market to trade. And of course, guys, this is a horrible market and choppy market to trade. Now that we have made a difference, let's go to this amazing uptrend. Okay, you can see that we are making higher lows. We have the first low here at the bottom of this down move. We first make a high, and then we make a low. We have a new low that is higher than this low, and a new high that is higher than this high. We are now in an uptrend, okay, and we will be looking to trade the trend, okay. In this advanced course, we will teach you everything you need to know to make your trading easier. And I'll be honest with you guys, when you make your trading easier is when you see your profits rolling in. I mean, it's great to find peaks and counter trend trade, but it's easier to just trade the trend and take your profits in. And this is because when you trade with the trend, you will have a higher percentage of winning trades than if you are just looking to sell tops and buy bottoms. Okay, so let's return to this trending market, and as you can see, we are in a trending market up until we arrive to the middle of this range. Let me show you with the rectangle what I'm talking about. Now, after we made this new high, we made this new higher low, and we made this new higher high, barely a new higher high, and then we started to trade inside a range. Now, this is a let me see, this is a 75 pip range, which is nice, because in a 75 pip range you can profit from 30 to 45 pips on each trade or on each bounce of support or resistance. But since we are in a ranging market, we decide to wait for the breakout of this consolidation period to trade the upside of the breakout, and when we break above it and retest this resistance as support, we have an entry for a 130 pip winner. Okay, so this is what a consolidation period would look like on an advanced continuation pattern. But as I already told you that on the future lessons we will teach you all about continuation and reversal patterns, okay? But you need to understand here on this lesson that sometimes when you are in an uptrend, you will enter a range before continuing with the main move. So everything is about perspective, okay? You don't want to be that trader that gets cut in the first level of thinking, okay? That thinks, okay, we are in a range, I'm gonna look for bounces of resistance to sell and bounces of support to buy. No, you see that the entire picture. We are in an up move, okay? We are in an up move, and since we are in an up move, and since you see that the move up has been very aggressive, you can assess that this is actually just a consolidation period before the continuation of the move. So you are going to trade the main move and not the range in the middle, which is just, as we told you before, a consolidation period before the next jump. We will get into depth on these patterns on future lessons.